If you are retiring before age 65 when you can get Medicare, you're probably wondering how to get health insurance until that point. So in this video, I'm going to go over what I think are the 6 options to consider for that. And I'll give my color commentary on each one. So I've got a document here I'm just going to pull up. So, and this is in my health insurance guide, by the way. If you want to access that, I'll put a link in the description. There's no sign up or anything. So here are your options. And I'm going to go in the order of just, we're getting close to what you're probably used to, and then getting into a new realm of buying your own health insurance. So the first option is Cobra. So this is continuation of your current group health insurance plan. So if you do work for a company that offers health insurance as a benefit and you are on that plan, then when you leave that job, you can continue on that health plan for up to 18 months. So the pros of this, you're probably familiar with the plan. You know if your doctors are in network and that type of thing. That really comes into play, I would say, only if you are in the middle of treatments for something, and you really just want to make sure you don't rock the boat. You don't switch health insurance plans in the middle of, you've got a surgery scheduled or what have you. So that's the real benefit of keeping that plan. The cons, so it's expensive. When companies offer a group health insurance plan, they, in most cases, need to pay for at least 50% of it for the employee. So you lose that when you go on Cobra. You can keep the plan, but you can't keep the subsidy, if that makes sense. So your cost is going to double at least. If your company pays more than 50%, then that's that much more that you're going to have to start paying. So that's a big knock against Cobra. And then again, the 18-month maximum. It's not something you can keep rolling on year to year to year until you hit 65. So that's Cobra. The second option would be your spouse's group health insurance plan. So if you have a spouse or domestic partner and they have group health insurance, you can join that plan as a spouse. So you can either join mid-year. Usually when you lose other health insurance, like from your company, for instance, that is a qualifying life event in the terms of the other plan, your spouse's plan, and you would be able to join via a special enrollment period. So that would be mid-year. You want to confirm that with the HR department, the benefits department at that company, at your spouse's company, but that's usually the case. If you miss that window or for some reason you can't join mid-year, then you can then most likely join at the beginning of the next plan year, which is usually January 1st, but some companies start their plan year on June 1st is a popular one. So this has been, I would say, the default option for a long time, because it's just, hey, it's what my spouse is on. Let me just pop myself on there. It's familiar. Good to go. And that makes sense. But I would say that you're missing an opportunity to really compare your other options, especially when it comes to just how cost effective this is. So employers, if they offer group health insurance, they have to subsidize some of the cost for the employee coverage, but they do not have to subsidize some of the cost for a spouse or children. So in many cases, this is becoming more and more common. The company doesn't subsidize the spouse or kids at all. So you're paying full freight. So you're not really getting a deal in most cases. So compare, I'm not writing off this option, but compare that to the other options I'm going to discuss here in a second. And don't just blindly select your spouse's plan and assume that's your best option. Another con to this would be you're really limited to the plan choices that the company lays out. And usually the benefits department will say, for this year, we're going to offer these 3 plans, and we've chosen these 3 among probably a dozen different options. So, maybe on the open market, there's a plan that is more tailored to you and your needs that just makes more sense. Not always the case, but it very well could be. So this next option, I'm going to bet is probably what makes the most sense for most people watching this. So this is the Affordable Care Act, ACA exchange. Other terms for it: Obamacare, healthcare.gov, the marketplace, the exchange. All those terms mean the same thing. It's a federal marketplace like an Amazon.com, where various insurance companies who want to participate, and most of the big ones do, on the individual market. And all these plans are, they pass muster with the Affordable Care Act. So there are a lot of consumer protections in this, in every single plan, no matter whether it's an expensive one or an inexpensive one. They all have minimums that must be met to be on the exchange in the first place. So that's no pre-existing condition limitations, no underwriting, no benefit maximum. So like once you hit $1 million in claims, they can't say you're cut off. It's unlimited. And then each plan has 10 essential benefits. Like the easy way to describe this would be like your preventive care. So your annual physical, well women's visits, things like that. That's going to be covered. Some of those free of charge under every one of these plans. And the other pro of this is there are subsidies available. And most people, just by the statistics, most people with most common incomes in this country do get some form of subsidy. The less money you make, the more your subsidy is. But you'd be surprised how high your income can get before subsidies run out, or you wouldn't qualify for any subsidies. So that's a good thing. The cons of these plans: the networks are smaller or more restrictive than maybe what you're used to, or maybe what you would ideally have, which I think it's a little bit overblown, but it's a valid point. So most of the plans I see are either HMOs or EPOs, which is to say you have to stay in the plan's network when it comes to doctors, facilities, hospitals, specialists. So it's very important. It's vitally important to make sure that your doctors, or the ones you want to see, are in the network of the plan you choose, or at least you're on a plan where they've got a decent network in your area. So that's a little bit of diligence you should do when shopping for these plans. I've got videos on my channel about that more in depth. So again, ACA exchange plans, again, this is likely going to be your first stop if you're not going to do COBRA or your spouse's plan, and probably what you can end up going with. The fourth is what I'll call an off-exchange ACA lookalike plan. So this is really more for people who make too much money to get a subsidy on an ACA plan. And so, you're staring at the prices on the ACA marketplace, and you're like, this full price, this is crazy. Isn't there something out there? Isn't there an alternative that's off the exchange that I can maybe look at? Could I get a PPO network? I'd be willing to pay extra for a PPO network. Is that available? So the answer is yes. And recent years, there have been some smaller insurance companies who have recognized that need or that desire among that group of people. Whoops. And they have designed their own health plan that looks just like an ACA plan. It's got all the benefits, all the core features of it. But the main difference is they limit who they allow on the plan, which is to say they want healthy people or reasonably healthy people on the plan, because what that allows them to do is, if you think about it, they can lower the price. It's not half price or anything, but it's lower. If you think about it, if you got healthy people on a plan and they're not using a ton of health care, or they're not so many heart attacks or instances of cancer or expensive drugs, those people are going to be less expensive to insure. And so the rates can be kept down. So that's the value proposition of plans like this. So the cons: underwritten. Okay. But if you're in reasonably good health, it's not a big deal. And then there aren't any subsidies available. Obviously, these are designed for people who are healthy and make too much money to get a subsidy on the ACA exchange. The fifth option is short-term health plans. So this has been the option I just went over, the off-exchange ACA lookalike plans. It's not really a well-known option. And so the people who don't get a subsidy, they make too much money, they've flocked to this historically, short-term health plans. And United Healthcare is really the king of this market. And so you've been able to get up to 3 years of coverage in a plan like this, even though it's a short-term plan. Now that is ending. Your limit will be up to 3 months starting in the fall of 2024. So I wouldn't count this as a long-term play, as the name of the category of product suggests. But if you are in a situation where you just need 90 days of coverage, 30 days, 15 days, 7 days of coverage to get you to the goal line where you can start Medicare, or till the next plan year for an ACA plan, if you didn't have a special enrollment window, that's exactly what this is for. You can enroll, I think, as early as the next day in most cases. The cons of this, they are underwritten, so you're going to have to answer some health questions to be extended the offer for coverage. Again, you don't have to be like the image of health, but there are some questions. There are benefit maximums. So if you hit $500,000, $1 million, $2 million in claims, depending on the plan, there is a limit. And then every dollar after that, you're on your own. And in many cases, in most cases, I would say that's a lifetime benefit maximum. So it doesn't reset every year. There is no coverage for pre-existing conditions in most cases. And then, like I said, I'll just finish this list here, limited to 3 months. And I'm just going to assume that and make a recommendation based on that, because starting in the fall of 2024, that's going to be the case. The last option is not insurance, but it's a compelling alternative, and it's gaining more momentum with consumers, and that is medical cost sharing plans. Like Medishare is a popular one, but there's several others. Sedera, S-E-D-E-R-A, is a newer one that is not faith-based, unlike most of them. And the reputation that Sedera has is pretty darn good. I'm not affiliated with them or anything. I'm not necessarily recommending this, but that is an alternative if you're willing to go outside the box and get some sort of protection. Now, the pros of this, obviously, the reason you would even explore this in the first place is lower costs. So costs are significantly less than a full-blown health insurance plan, but it goes without saying, this is not insurance. So you don't have the legal protection, the regulatory protection of insurance law to, in case there's a dispute on a claim or a reimbursement, then you're not really going to have that degree of protection. So just fair warning there. So those are the 6 options I would consider for early retirees for health insurance coverage. Again, this is part of my health insurance guide, a bigger guide. It's a section in it. So feel free to access that free of charge, no email gating or anything like that. So hope that was helpful, and I will see you in the next one.